Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Tony Welch, Chief Investment Officer at SignatureFD, to discuss why balanced portfolios should perform quite well in the second half of 2023. Tony, it's great to see you. Welcome to Trade Talks.
Thanks for having me, Jill.
Let's talk about the macro first before we get into strategy. The first half of this year, a lot of surprises to kick off the first half of the year. What do you think had led to the performance that we saw in the market?
I mean, certainly I would characterize the first half of the year as a mega year of surprises, right? We came into the year, you look at where strategists were, you look at how investors were positioned, it was all resoundingly pessimistic. The story was the same. And anytime that the story is the same, you want to think about leaning against that story, right? So it was valuations contracted last year. Earnings are going to be the next shoe to drop this year. That's going to take us further down into the second leg of this bear market. And the market has done the exact opposite on the back of a lot more promising positive economic surprises that we've seen.
And Tony, we've seen a lot of the sentiment indicators go from pessimism to optimism. And you know how sometimes that can be a contrarian trade. Do you see any contraction in the fall, or do you think there's enough legs that we've seen in this bull market to carry it through the end of the year?
I think you really have to dice things into two distinct time periods. It's a really great point, Jill, because we saw pessimism through all of last year and for most of the first half of this year. That really long stretch of pessimism, when you get to optimism for the first time, from a technical perspective, that's more like a thrust indicator. It's a positive thing for the next 12 months. But when you look at things for the next 3 to 6 months, it tells us that, look, people are starting to embrace this rally. A lot of the positive surprises are starting to become more consensus, and expecting some sort of consolidation in the trend for the, kind of late fall or summer through late fall period would not surprise us one bit.
What are your thoughts in terms of another rate hike from the Fed? I don't know if you've noticed it lately, but gas prices have been up 20 to 30%, and that certainly factors into inflation.
Yeah, and I think that's the risk to markets right now is where can we start to get negative surprises, right? And the Fed is very much keyed in on core inflation, which core inflation should continue its disinflationary process throughout the rest of the year. But headline inflation is going to have a really difficult time getting below the 3% that we saw this last time. One, the easy comps are done, right? So now we have more difficult comps. And two, you are getting a little bit of an acceleration here in the headline items like food and energy. And also the other piece of that is around consumer sentiment, right? So the consumer sentiment has been improving greatly because the inflationary backdrop has been improving so rapidly, yet their wage gains are staying somewhat sticky. So real incomes have been rising. That's been boosting consumer sentiment. Well, what's the one piece of macro data that we drive by every single day that tells us what's going on with inflation? It's gas prices. And retail gas prices have been on the rise. And that's something that I suspect could be a bit of a drag for macro, for markets and what have you throughout the next few months.
Yeah, and I meant 20 to 30 cents. I think I said percent, but even still 20 to 30 cents
yeah,
over the weekend. Yeah. That is a bit of a shock to the pocket, let's to say. Another contrarian theme that you're taking a look at is the demise of the 60-40 portfolio. You think that a balanced portfolio is the approach to take into the second half of this year?
I really do. Bonds really haven't been there for you very well for the first half of the year. They've returned a little bit, but now you just have rates at a point where they start to look more attractive. And that's what really a balanced portfolio is there to do, right? If you get a little bit of headwind in the equity market, you're buoyed by the bond market. Now, we didn't see that in 2022. 2022 was a down year for both stocks and bonds. And many people were quick to throw in the towel on a balanced portfolio and say that this is dead, a 60-40 is dead. I mean, there are headlines about it. And that, and pitching alternatives as a way to kind of ballast the 60-40 portfolio. Listen, we love alternatives. We use alternatives here to supplement portfolios, but that doesn't mean that a core approach to building a portfolio isn't still valid. The one thing I'll say about that, Jill, in terms of last year was a unique environment where inflation was high and rising. When you go back and look at the performance of a 60-40 portfolio, that is the one environment that it hurts both stocks and bonds. Well, we are far removed from that environment. Any other sort of inflationary mix has been just fine for a balanced portfolio.
All right. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.